I'm going to be talking about some ways that you can adapt your trading strategy for a higher volatile market like we have here. My name's Tim Racette, and as Dave said, I do blog over at eminimind.com, and lots of good stuff to go over here in the next 35 minutes or so. So let's start with a little outline of what we're going to talk about. We'll kind of run through some of the basics and then work our way to some more intermediate to advanced topics, little nuances that I have picked up over the years. The first thing, we'll go through 3 of the tools that I use that are really great for day trading, and we'll talk about how you can determine which direction to be trading. And a lot of times, if you're day trading the futures markets, there's plenty of days where we're range bound and the overall trend might not be very clear. So I've got a couple of tricks that you can use to determine that trend and at least have a better opportunity to place some trades that are going to get going in your direction. There's a couple things that I do to get into a trade and a few things that I do to assess which trades do I want to take. So we'll talk about some things that you can do to make sure you're getting into a trade with relatively low risk. And then the fourth thing, we'll get into some trade management techniques that I use, some things that you can do to, regardless of what style or method that you're currently trading, some things that you can do to adapt your strategy to this higher volatile market. So for those that are unfamiliar with myself, like I said, my name is Tim Racette. I've been trading since about 2006. I primarily trade futures and stocks, a little bit of options, but those are kind of my 2 main gigs. Futures for day trading primarily, and then stocks for swing trading or holding overnight. So those 2 are, they kind of make up my trading in a nutshell. And I do find it very beneficial to have kind of 2 time frames to work off of. I got my start in swing trading stocks with a pretty small account, but it was a really good way to learn some of the fundamentals, and especially you learn a lot of patience when you're trading just a daily chart, because you have to wait all day for the candle to close before you can really assess your position. And you can also, swing trading stocks is good because you can do a lot of your analysis or homework after the market's closed when you're the most objective. So for anyone who's fairly new to trading, it can seem a little bit daunting to swing trade stocks, because in order to make a substantial return, you do need a reasonably sized trading account. Whereas $5,000, you can open a futures account and you can constantly trade that $5,000 in and out of positions all day long. And with some of the margins out there, you can trade 6, 7, 8, even 10 contracts with as little as $5,000. So, but don't let that kind of be the hurdle that prevents you from getting into swing trading. So I have had the pleasure of speaking at the number of traders expos, money show. I'm originally from the Chicagoland area, so I've been able to contribute to the CME, and I kind of got my teeth wet, if you will, or got my start down in the Chicago Board of Trade, having access just because I had a friend's dad who worked down there, and that was a really great opportunity to experience, what it's like to be in the trading pit and what differences there are between trading on the screen compared to trading down in the pits. And it's really they're two different worlds in some senses in terms of how you would go about making money. Outside of trading, I like to spend a lot of time outdoors. I like to mountain bike and get outside as much as possible. I'm a Arizona State Sun Devil graduate. Now I'm living in Arizona full time, but like I said, originally from the Chicagoland area, just north of Chicago. And for those that are on the social webs, you can find plenty of my videos on YouTube, and I'm also on Twitter and Facebook, so you can find me there. Well, let's dive in, shall we? Like I said, I want to start with kind of run through some of the basics and then get into some ways that you can adapt your trading style to these markets. So even if you are not necessarily looking for a new trading approach, you'll likely be able to pick out a few little things that you might be able to subtly add to your trading. I always caution people to, you don't want to spend too much time searching for a market or searching for a strategy, and you don't want to be bouncing around constantly from strategy to strategy, and then as soon as market conditions change, you kind of jump ship and then move to a different strategy. So if you have something that resonates with you, great. If you are looking for some ways to maybe manage your positions, we can give you some ideas for that. And if you're looking kind of starting from ground zero, we'll have an approach for you as well. So let's start with the tick chart. And the starting point for my trading, at least for day trading futures, is going to be the tick chart. And a tick chart is a time frame in terms of the x-axis, if you will. So we're pretty familiar with a 5-minute chart or a 1-minute chart. And a tick chart, instead of based off time itself, like 1 minute, 5 minute, 30 minute, the tick chart is based off of a number of trades that occur, or a number of transactions that occur in that market. So if you're looking at a tick chart, the bars are going to close, whether it doesn't matter if it's a bar chart or a candlestick chart, that individual bar is going to close after a certain number of transactions take place. And the number that I use is 512. It's a pretty common number for day trading, especially a market like the E-mini S&P, the NASDAQ, even the Dow, and some of the currencies. Tick charts are not super popular. You may have never heard of them before, but I urge you to at least take a peek at them. What ends up happening is in a really slow market, if you have to wait for 512 transactions to occur before that candle closes, if you look at a tick chart after hours, it's going to take longer for those bars to close. But if you look at a tick chart in right after the NYSE open, those candles are going to be forming, closing much faster. And so you can get a sense of the volume just by the pace or the speed that those candles are forming. So they're directly derived from price. And so it's a sort of encompassing way to get a sense of volume, look at the price action, and have a kind of a good read or feel of the market. So if you didn't know this was a tick chart, you would say, well, that could be a 5-minute bar, it could be a daily bar. So the visual is really the same of what you might be used to just looking at a traditional candlestick chart. So what I pair my tick chart with is what's called a Heikin Ashi candlestick. And this is probably something else you may have not heard of or not be super familiar with. It's a variation of the traditional candlestick. So it's similar, and we'll look at two side by side. So the traditional candlestick is made up of an open, high, low, and close. And the open price with a Heikin Ashi candlestick, this slight variation, it starts from the midpoint of the prior candle. So you end up with a chart. This is the same time period in both of these charts, but your chart ends up getting a little bit cleaner look to it, whether you use red and green bars or whether you're using filled and unfilled candles. That really doesn't matter, but you're going to end up with these cleaner streaks of price and trending, because the candle itself is starting, once the prior candle closes, the new candle starts from the midpoint of that prior bar. So it's a nice visual to help determine, what is the current trend, and then where is the trend changing, and we'll get to that in just a minute. But the color-coded bars really help sort of clarify that direction. If you've ever switched trading platforms or moved some things around on your trading screen, it takes a little time for your eyes to get used to the new layout. Maybe you change from a black background to a white background, and your eyes get accustomed to seeing things in a certain way or looking at certain parts of the screen. When I first began trading, I had 3 monitors, and I've since stripped away a lot of the excess, and I can get everything down just on one monitor, and I'll toggle back and forth between charts. But if you can simplify your screen, that can be a really helpful way to simplify your entries, because you're not looking at so many things that need to happen in order to place that trade. And then that can help reduce some of the hesitation that you might feel to get into a trade in the first place. So the trend changes really become obvious when you have some sort of color coding, whether it's white and black bars or green or red bars. I personally use Thinkorswim by TD Ameritrade for my platform, and those are the charts, and these examples are just the standard toss charts. So I really like this duo of the 512 tick chart with that Heikin Ashi candlestick study on top of it. I feel like it's a good visual representation. If you're trading intraday, you're getting enough data. If you're trading a market like the E-mini S&P or the NQs. I'm not a huge YM fan, just because the price moves so fast on the trade ladder. It can at times be kind of hard to manage positions as you're kind of dragging your stops around or moving your orders around. You can auto center, but it is challenging, to say the least, at times. Where if you have like the E-mini S&P or the NASDAQ, it can still move quickly at times, but typically you're going to have a little bit less movement on the trade ladder. So if you're newer, the YM is nice because it's $5 per point, but the NQ is also $5 a tick, and so you can kind of get that same benefit by starting on the NQ and then maybe moving over to the E-mini S&P, or with the introduction of the micro futures now, you can start on the micro ES and have it $5 a point, and then you can work your way over to the larger main E-mini S&P contract at $50 a point. So that's a nice way to sort of go from paper trading to trading real money to trading the larger ES contract. Just be aware, if you're trading the micro contracts and you find yourself trading 10, 20, or 50 lots, you might as well move to the big contract and save yourself the commission. So John asked if I use the 512 on both the ES and the NQ. I do. And most of the currencies as well. If I find that like the euro, the 6E, has since gone from a full pip to half pips about 4 years ago or so, and I find that a 233 chart works a little bit better for that. That's about the smallest I would go. Those are kind of the standard numbers. You go 144, 233, 512. And so if you go too small, then you're going to end up with a market that just doesn't have any movement or volume. But sometimes I'll go between the 233 and the 512 for trading the euro, and that helps give me a little bit more undulation and points that I can work off of. So this combination, I'm just using these combinations for day trading. So at the start, I just highlighted a little bit about stock trading, and this is primarily focused on day trading. With swing trading, I'm just looking at daily bars. So we'll talk about specific examples to the ES here, and then I can bring some stuff in about swing trading as well, especially when we get to managing the trades, because the approach that I use for trailing my stop, tightening my stop, moving things around as the trade goes in my favor are essentially the same things that I do on daily bars as well. If you're looking at like the SPY or some of the ETFs, the corresponding like SPY for the ES or the Qs for the NQ, you can start with a 512 tick chart as well. So when we put the two together, when we take the tick chart and the Heikin Ashi candlestick and we smush them on top of each other, this is what you get here on the right. So again, same chart, but most of us could look at this chart on the left and say, yeah, it's a downtrend, and then we move into a sideways trend, and then we move back into a downtrend. But when you look at the chart on the right, it really makes it clear that this downtrend, it's a sustained downtrend for the entire move lower. Whereas just by briefly glancing at the chart on the left, you might come in and say, okay, well, we kind of moved higher a little bit here and higher a little bit here. Are we reversing? Well, with so many inputs coming at you throughout the day, especially if you're day trading in the morning, kind of right after the NYSE open, it's just one more way to help simplify and clean up your screen so that your eyes can look at the chart. You can quickly identify the trend or lack thereof, as would be, in this kind of a situation where we're kind of going back and forth and moving sideways, and then you can be better positioned for placing trades. Rodney asks if you need an MBA to be a successful trader. No, I would not say so. I do not have an MBA. Okay, so let's talk about identifying the trend using the kind of that combination to help us identify the trend. If you're looking at a daily chart, if I'm looking at a daily chart, I will typically just use traditional candlesticks because they give you a little bit more information related to the emotional state. So if I go back to these two charts side by side here, the shape of the candle, for anyone who's studied traditional candlesticks, tells you a lot about what was happening during the course of that bar or that trend. If you have long tails versus big bodies versus candles that open and close at the same price, all of those things can help give a sense of who had the upper hand, whether the bulls seemed like they were in control or were the bears taking control. And So if I'm looking at a daily chart or any kind of larger time frame, 15-minute chart, I'll just use a traditional candlestick. So if we really want to hone in on, okay, when should I use the tick charts with the Heikin Ashi? It's really just for placing trades on the smaller time frame when you're day trading. So when it comes to identifying the trend, just like in football or sports, as they make really good analogies, going back to the basics is really, really helpful. And those fundamentals really carry you through when things get a little wonky or the markets start doing crazy things. So we can probably all agree that the market is not going to go straight up and straight down with no undulation whatsoever. There's going to be some kind of stair stepping or waves or whatever you want to call it. Kind of goes up and pulls back and goes up and pulls back, or it goes down and it bounces and goes down some more and it bounces. So we know that about the market. And all of this movement is driven by human behavior, the emotions that we have, whether the computer or the algorithm is executing a trade, those algorithms are all built by humans. Big institutional investors that make up a very large part of the market are individuals who feel those emotions. And we all know what those two emotions are: fear and greed. And so what makes up the trend? Well, that's pretty simple. Higher highs and higher lows is an uptrend, and then the downtrend is lower highs and lower lows. So if we take that structure and we look at where are the highs and where are the lows and how do they relate to one another, we can simply go through the day and find the lower highs, and then we can find the higher highs and we can mark those. And just by looking at, okay, this high here is higher than the prior one. All right, great, that's a higher high. And if we look at the lows, we say, okay, well, this low is lower than the prior one. And then I come over to the next one. Oh, this one's a little bit higher than the prior one. And that's a really great exercise to print out a chart. If you're mostly focusing on the morning, you could print out like a 2-hour chart of the, like 2 hours worth of the 512 tick chart if you want. You could simplify it even more and just print out a daily chart of the market that you're trading, or a 5-minute chart, just to go through the exercise of finding all of the highs and lows and then relate them to each other. Just put a little LL for lower low. You can just use initials, higher low, HL, and then you can go through and kind of either take a highlighter or a pen and just draw the different trends that make up the day. You might have half hour of an uptrend and then half hour of a downtrend, and then the market goes sideways for a while. And that's just another way to really help ingrain those fundamentals and train your brain to spot the trend changes. Because once we can identify, okay, here's a downtrend and here's an uptrend, or here's no trend, we're just moving sideways, we can better understand and be able to identify when the trend is changing from down to up or up to down. So when it comes to identifying that trend change, the key point, or the key zone, if you will, is when we take out a prior swing high. So if we're going down, making lower highs, when we put in our first higher high, that's the earliest sign of the downtrend is now changing or potentially changing. And it's solidified when we form a higher low and then rally, breaking that higher high and starting that series of, in this case, higher highs and higher lows. And so this area where we change from lower high, lower lows to higher high, higher lows simply by breaking that swing high, or if you're looking at a short, breaking the swing low. That's the key point. And it doesn't matter if you're on a daily chart, a monthly chart, the 512 chart. That is the area that you want to be placing your trades in terms of, getting in the trend early. There's always cases for, looking at a strong trend, waiting for it to pull back, and then getting in that trend in the direction that the trend was heading. And if you're trading intraday, you know that there's a lot of trends that kind of start and then they run away, and then the market's up 20 points, or in this environment, it might be up 50 points, and you're just kind of sitting on the sidelines. So if you can watch for these areas where the market's going from downtrend to uptrend, that's a really good point to be, focusing on where should I be looking for trades as your number one goal, and then executing trades in those areas, as opposed to just having a setup that you just kind of throw at the market, whether it's up, down, or sideways. There's going to be better opportunities or lower risk times to place those trades. So let's talk about how I like to get into my trades. So I'll wait for that break of a swing high if I'm looking to go long, or a break of a swing low if I'm looking to go short. And just by identifying, okay, here we are, we get a little bit of a rally, we break above the swing high, then I can come in and just look at just using a very simple fib retracement tool, let the market pull back to that halfway point and look for an entry. You can also, just let the market come back and buy above the high price of the lowest candle in the pullback. That's a great approach as well. With day trading, I find that entering at the 50% gives me the best reward to risk. Whereas if I wait for a little more confirmation, or wait for, I'm not a big moving average stochastic kind of guy, but if you sit around, you wait for lines to cross and trend lines to break, all of a sudden, the market's up 5-10 points and you're still not in the trade. So I like to get in the trade when people aren't necessarily looking at it or talking about it, or it's not the hot ticket item. You kind of want to be thinking a few steps ahead, and you're doing the opposite. Just like if the market sells off as everyone's panicking, well, the smart traders and investors are buying up stocks when 2008's happening and the economy is looks like it's gonna dive off a cliff. So you just use a simple limit order that protects you from getting in the trade and having a bunch of slippage. Price has to come down, and importantly, it has to trade through your order. If you're on a sim account, it's a lot of times the market will just come to your price and fill you. Then you go to live and you're like, well, why aren't I getting filled? Price touched my order. In a real account, the market needs to trade through your price. And I haven't been on a paper account in a while, so maybe some of the platforms have adjusted for that. But when I first started, that threw me off a little bit. That was 10, 12 years ago now. So, all right. So how do you, once you get in the trade, where do you want to place your stop, and how do you manage the position? So again, regardless of how you're entering, you could use the fib tool, the 50%. You could just buy above the high price of the low bar. But I'll put my initial stop below the 61.8 if possible. And then what I like to do is trail my stop, because you never know if the market's going to be a big runner or if it's just going to go up, a couple of points in reverse. But rather than try and swing hard at every pitch or at, swing your golf club to try and hammer out a huge drive. I find it much better to just swing consistently and use the same technique, use the same trade execution, and then if it ends up being a runner, great, you're in position for that. But if you swing at every pitch like it's going to be a home run, then you end up missing quite a few. So I got two approaches for you to trail your stop. The first one's a little more conservative, and it just involves trailing swing lows as the market's rallying. So again, it doesn't matter if you're day trading, looking at daily bars, whatever time frame or market you're looking at. If you're in a trade and it starts to work its way in your favor, if you just let it, give it a little bit of room to make that next pullback and then take off again in your direction, you can just systematically tighten your stop up underneath that swing low. And I'll just use, a tick. In this market, I'll use 2 ticks below the candle, below the bar. If you're trading stocks, you can use 10, 20 cents. But just, tightening your stop up underneath the swing low, the market starts to run up, and then it pulls back, and then it returns to new highs, and you just bring your stop up to the next swing high. Or swing low, excuse me, for longs. You'd be using swing highs for shorts. So that's a little bit more conservative approach because you have to let the market pull back a little bit before you tighten your stop. Well, the second option or the second approach that I'll use is a little more aggressive, and you probably notice, like in this particular example, you get a quick run up. Well, between the 2 white lines here, in this environment, that could be 10, 15 points at times. And that's a lot of room to have your stop down here, have the market be 10 points above you and saying, okay, I'm gonna let it come all the way back to where my stop is. So, and the market starts moving quickly, what I like to do is just trail my stop below each candle. And then the 512, they can really move quickly. And so you don't always get it underneath the exact candle, but in general, you're just kind of following along on your trade ladder and just dragging up the price. If you have your trade ladder and charts tied together, like you can do with Thinkorswim, you can just drag your line up on the chart and it'll move your trade ladder for you. But that way you can keep your stop fairly tight and get out of the trade as soon as the momentum changes when the market's moving quickly. So that's a really good technique. You can do that on daily charts as well if you're swing trading. The same approach works. So when the market is much more volatile, how do you adapt rather than starting from scratch or turning to a new strategy? The first thing that I'll do with day trading, if we get into a situation where volatility is like above 35, is double the stop size. And then at the same time, I'll cut my position size in half. So that gives you a little more wiggle room when you enter the trade, and it keeps your risk the same. And that's really the most important thing, to keep that risk per trade the same. I'll go to the aggressive trail stop approach right off the bat, because if the market's going to be moving faster and the ranges are bigger, I don't want to let it come back 10 points and give all that up. So I'll just go straight to the aggressive trail stop, and I will also have a fixed target. So if you're using the Fibonacci tool, I like to use the -23. It's essentially about 20% beyond highs of the move, or you could use a fixed target of like 3 to 1, even 4 to 1. So if you're using a 3-point stop on the ES, you could just have a fixed target of 9 points and then trail your stop at the same time. So you have this fixed target above you, and at the same time, for a trade that's kind of working in your favor, you can tighten it, and work your way towards that fixed target. So a couple of things. The tick chart and the Heikin Ashi really help add some clarity for day trading. and add a nice visual cue where you're not spending so much time deciphering each candlestick or each bar. They can help you identify the trend and help you, get in on pullbacks or sell bounces when you're looking for those trend changes. We talked about lower highs and lower lows changing to higher highs and higher lows. And it's at that point where we can look for a little bit of a bounce. The market's in a downtrend. We get that break of a swing high, we get a little bit of a pullback, and then boom, you can jump in. And that's what makes a low risk entry point, because it's the start of the trend. So when you're looking at these higher volatility environments, if you keep your risk the same size, so let's say you're risking $75, a point and a half on the ES, or let's say you're doing 2 contracts, so it's $150, 3 points, and volatility's higher. So you cut your position size in half, and you trade 1 contract with a stop of 3 points. Now your risk is the same, $150. And because the volatility is higher, you're gonna have a bigger range. So yeah, you're only trading 1 contract, but you have a better chance of the market going 9 points when volatility is at 50 or 60 than you do when volatility is at 12 or 13. And so focusing on, okay, how can I keep my risk amount the same, but trade, keep the same risk amount in order to keep that constant through the higher volatile time. So if you want to check out anything else about myself, my strategies, anything like that, you can head over to eminimind.com. If you have questions, you can email me, tim@eminimind. And if you want to check out a whole host of videos and trading logs or spreadsheets that I use to record my trades, I have all of that put together in a little VIP section of the blog, and you can check that out for free for a month over at eminimind.com/free month. So I know I think I missed a handful of questions in here. We got a couple of minutes, so let me see if I can flip through a few of these and get some answers. So John asked if I pick a time frame and stick with it during the day. Yes, in terms of the 512 tick chart is the time frame that I'm using to place my trades. So I'll occasionally glance at the daily chart or glance at the 15-minute chart just to kind of see the bigger picture, but I'm executing when I day trade ES on the 512 tick chart. As far as starting out with futures, the barrier to entry is very low. Most of these, discount brokers, you can get $500 intraday margins, but I wouldn't encourage that to be the reason to trade futures, because if you're in a position where you're so strapped for cash that you can't, afford to have a losing trade, or you're gonna have to pull money out of the account, then you're really not doing yourself, you are doing yourself a disservice. So if you can put the emphasis on, okay, I'm gonna learn how to trade, I'm gonna, learn a strategy of some kind, I'm gonna practice on a paper account, figure out how I'm gonna set up my charts and know where to click on the trade ladder so I don't make any silly mistakes when I go to live. Then switch to live, start trading the micro contract, trade 1 contract, just kind of get a sense of what it feels like to have real money on the line. And then if you can overcome some of those emotional kind of pulls on you where you might make some bad decisions in the moment just because it's real money, once you can overcome those, then you can start going to multiple contracts. And if you can get to 2 or 3 contracts, that's a really good way to be able to start trading and managing positions. It really doesn't do you much good to trade one contract because you don't learn much. You're in and you have to be out at one point. So that would be my advice for starting out with futures. Again, don't let stocks scare you, but it does take a little bit more capital. So thanks for tuning in, everyone. Again, tim@emoneymind.com if you have questions, and I hope everyone has a great rest of your evening and be well.